My name is Robert Stewart with Keller Williams Select Realty in the Twin Cities. I use market data and 16 years of experience to help my clients make fantastic housing decisions when it's time to buy and sell. This is my market review for the first quarter of 2023. Things are a little weird right now. Let's take a look. Let's talk about home sales. So we've had two big run-ups in the last 30 years. The first was in 2005, and we remember that when housing went haywire. And then through here it crashed, and this was the Great Recession, and then it came back. Then we had the last 5-year period. So the last 5-year period was the second greatest run-up in recorded history for real estate. And then between 2022 and 2023, sales fell by 1.1 million. You can see that right here. Here's why it happened. We began the year in 2022 here in January with a very, very high sales rate here. That's a seasonally adjusted monthly sales rate. And at this time, inflation was running rampant. Prices of everything were going up, and the government said, whoa, we've got to put the brakes on things. The market's too hot. So they applied the brakes. And the way that you apply the brakes to the market is through interest rates. Interest rates went up. The cost of borrowing money went up. And we can see the effect month over month as it dipped and dropped and home sales fell. They fell to May of 2020 levels. This was the epicenter of COVID. This was right in the thick of it. So that's where we ended the year. And that's precisely why we ended the year with a 1.1 million fewer homes sold. One of the most common questions I get asked is housing overpriced? Let's take a look at that. Here's a graph of home prices going from about 1990 there to present. Pay attention to the blue line, this trend line right here. That trend line represents 4% annual growth. When you take all the booms, all the busts, all the economic pressures on the housing market, it produces about a 4% trend line, meaning your home gains, on average, 4% of its value per year. You would think ideally that you could predict home values with this trend line, but you can't always. Come to 2005, we had a really interesting economic pressure. People were getting loans who shouldn't have them. If you could fog a mirror, you could take out a loan for whatever you wanted. That's bad practice, and it caught up with us. But that many people taking out loans inflated home values 21% above this trend line. They defaulted, they went into foreclosure, and history told us what happens. The Great Recession. So now home values fell below that line. When housing prices go above the line, we call that an overpriced home. When it goes below that line, we call that underpriced. So then the market started to recover, but the trend line is still going up. So it recovered, never quite caught up until about 3 or 4 years ago. It was in this time period where we went over the line about 12%. But you can see here what our prediction is for 2023 with regard to home prices. They're staying about the same. There might be like a point or a fraction of a point loss, but it's basically stable right here. Now, if the home price stays stable, but the trend line continues to go up, you're going to see that housing will be perfectly appropriately priced within a year or two. Another question I get asked is, why is inventory so low? The short answer is, there's about 4 million homes missing from the market because they were never built. Since the Great Recession, new construction has underbuilt by about 50%, and they're not really catching up. So let's talk about inventory. It's one of my favorite topics. It's not measured in units, rather in months. We talk about 1-2 months of inventory. And here's what that means. 2 months of inventory. If nothing new came on the market in the way of new listings, everything that's currently listed would sell within 2 months. So that's what that means. It's really the amount of time something's on the market. So 1 month, 2 month, the 6 month point, if we have 6 months of inventory, that's a market that favors buyers and sellers equally. If we're below 6 months of inventory, things favor sellers. If they're over 6 months, they favor buyers. Nationally, we're at 2.7 months of inventory. And here in the 7-county Twin Cities metro, we're at 1.7 months of inventory. Very strong sellers markets. In certain neighborhoods, we have 2 and 3 weeks of inventory in popular areas. The number of months of inventory is incredibly important because it dictates the rules of the market. Your marketing, negotiation, and positioning are very different at a 1 month point as opposed to a 2 to 4 month point. I've seen a lot of agents over the last year use 1 month rules for a 3 month market, and they're getting caught with longer market times, numerous price reductions, and ultimately accepting an offer that's way below fair market. What we're seeing right now is an incredible amount of demand placed on a very small housing inventory. That's what's sustaining our prices. Let's talk about affordability. And one of the reasons that the housing market right now feels just a little gross. Here's why. Since 1970, on average, people have spent about 20.3% of their gross income on the principal and interest payment of their mortgage. So that section of their income went to their living. Now, for the last 10 years, we've been spoiled. 13 to 17% of gross income being applied to your mortgage. Raise the interest rates, raise the payment. That's why affordability in 2022 is at 24%, 24% on average of people's income being applied towards their mortgage payment. It should be noted too that first-time home buyers, their affordability is usually 34 to 35%. And that's because they're typically young in their careers, they're early in their income earning journey, and as their income rises, that number is going to decrease. People buy homes to lock in their cost of living. It's not getting any cheaper. Let's talk about interest rates. For the last 10 years, we've had artificially low interest rates, and now we're paying the price for it with inflation and compensatory higher rates. Rates are higher now than they have been, but let's put them into context. So we have this top trend line right here. That's the 50-year average for interest rates at 7.81. We have the 30-year average of 5.97, and for the last 10 years, the rate was 3.8. And I hate to say it, but it's very possible that we will never see 3% again in our lifetime. And it's highly probable that we'll never see 4%. There are ways to mitigate the effect of interest rates that a great real estate agent and lender can put in place for you to soften the blow of these rates. But waiting isn't one of them. I hope this video helped you understand the current market. My goal is to help you make fantastic housing decisions when it's time to buy or sell. Did you find this video useful or want to support my real estate practice? Share this content in social media with the hashtag TwinCitiesSouth. Thanks for watching.